Hi, I got your email and I will be happy to teach you about the basics of investing. But before we do that, we really have to develop an investment plan. Now, an investment plan is largely derived from the information in your financial plan about your goals and your values. And having an investment plan can really help you stay on track emotionally when the market is going up and down and there's a lot of volatility. It helps take the emotion out of the equation, and together with me, your advisor, can help you stay on track. Now, in the market, there are three primary investment vehicles. There are stocks, there are bonds, and there are mutual funds. Now, a stock can be thought of as a ownership in a company. One share of Exxon means that you are a part owner of Exxon. A very small part owner, but a part owner nonetheless. The stocks are the riskiest. They can go up, they can go down, and a company can go bankrupt, but also the most long-term growth out of any of the other asset classes. Bonds are a loan. Think of a 5-year bond as a 5-year loan to a company or government. You get interest payments over that time period, and at the end, you get your principal back. But it's not really a growth asset. It's much more of an income asset. So a stock is ownership, a bond is loanership. It's a really good way to kind of balance the two in your minds. Whereas a mutual fund can contain stocks or bonds. But the difference is, if you've heard the statement, don't put all of your eggs in the one basket, a mutual fund is the stock market's way of protecting against all of your eggs in one basket. A mutual fund can have thousands of stocks in it. That way, if any one of them goes bankrupt, it doesn't really affect the fund all that much. And the same thing holds true for bonds. A bond mutual fund can have thousands and thousands of bonds in it. And if any one issuer of those bonds can't pay, it doesn't really affect the fund all that much. My firm exclusively uses mutual funds and ETFs for both stocks and bonds. And an ETF is pretty much just a mutual fund of another color. Now, you start an investment plan based on what's in your larger financial plan. You take your goals and your values, and then you translate it. Okay, what sort of return do I need on my investments to meet these goals? And how do I want to invest based on my values? So you back into your return. In your case, you are the inheritor of money, but not so much money that you can afford to stop working. You're a relatively high-earning, white-collar professional, so we're going to invest two different ways for you. We're going to take the 70-30 allocation for the money that you inherited from your dad. We're going to focus a little bit more on asset preservation rather than growth for the money that you inherited. It'll still be invested fairly aggressively, but it's the 70-30 asset allocation historically has provided somewhere between 8 and 9% return broadly, whereas a more equity aggressive allocation is maybe closer to 10 or 11%. But the volatility is much higher. So the money that you've inherited, like I said, 70-30 allocation, you have a very long time horizon. You're only 35. So if you work until you're 65 or 70, you're still looking at a very, very long time horizon. So I will be comfortable with you as your fiduciary recommending a 70-30 allocation for the money that you inherited. Conservative enough, but also aggressive enough for your long-term goals. However, your ongoing allocations within your 401k, we're going to make those probably 100% stock. We can review this on your next meeting with me, but I would say that a 100% equity allocation for your new allocations, for your new weekly contributions or bi-weekly contributions, we're going to keep those as 100% equity. And the reason is you still have to grow this in order to meet the goals in your overall financial plan. Now, we can talk about this next week when we have our meeting. And please feel free to send me an email with any updates, and I will see you then. Bye.